A survey conducted by Standard & Poor's said that 67% of people worldwide cannot correctly answer at least 3 out of 4 financial concepts involving inflation, risk diversification, compound interest, and numeracy. This means that 3.5 billion people worldwide lack an understanding of basic financial concepts. Hi, my name is Jordan Hyde, and I'm with New York Life. Yes, I'm wearing shorts, and today I want to go over a simple concept that we refer to as the 3 tax buckets. The reason I want to go over this concept with you is to make sure that you know that in retirement, the most important goal is not to accumulate the most amount of money, but to make sure that you have more money in your pocket and less in Uncle Sam's pocket. Let's get to it.
This is your lunch. Now, you should be able to do whatever you want to with this, right? If you want to eat all of it, great. If you want to throw it away in the garbage, that's your prerogative. But here I come, the government. And I get to take 40% of your lunch. And that, Lauren, is how taxes work.
In the US tax system, there's 3 different ways that you can be taxed. You have your tax now bucket, your tax later bucket, and your tax-free bucket. In your tax now bucket, this is where you have things such as your checkings account, your savings account, your pay stub, brokerage accounts, your certificates of deposits or CDs, things of that nature.
When you have taxes taken, you get a job every week and they just take the taxes out of your check. They just take it. You don't get a choice. You just take it, and they keep taking it to the end of the year where they're like, hey, I think we might have took too much. Here's $500 back. Go buy yourself some sneakers or something. And you're like, thanks, government. We're going to Red Lobster tonight. This is amazing.
In your tax later bucket, this is where you're going to find a majority of your retirement accounts. So this is where you're going to find your 401k, which is an employer-sponsored retirement plan, your 403b, which is for teachers and healthcare workers, which I want to stop here and say thank you for being a frontline worker, especially during this time of COVID. Your work is truly tremendous, and we appreciate everything that you do here at New York Life. Thank you for your service. In your tax later bucket, you're also going to find your 457 plans, which is for government employees, such as your firefighters and police officers. Thank you for what you do. This is also where you're going to find your TSP, which is a thrift savings plan, which is for military workers. Thank you for your service. This is where you're going to find your simple IRAs. An IRA stands for individual retirement account. A simple IRA is for small businesses for less than 50 employees. This is where you're going to find your SEP IRA, where it's going to be for your 1099 employees and your real estate agents. This is where you're going to find your traditional IRAs. This is also where you're going to find your TRS, or your teacher retirement system. So in your tax later bucket, you're going to find all your pre-tax vehicle retirement accounts. Now in your tax-free bucket, you really only have 2 different ways that you can grow your money tax-free. The first being some type of Roth vehicle, whether that be a Roth IRA, individual retirement account, or a Roth 401k, and the second option is cash value life insurance. Now you may say, what is the importance of all 3 of these? Now let's break them down. All 3 of these have some type of pro to them. So with your tax now bucket, the reason why somebody would want their money in a tax now bucket is because it's liquid. It's easily accessible. I can always go onto a phone app and pull out money from my checkings or savings, or my pay stub, brokerage accounts, whatever it may be, and access that money as soon as I need it. For a tax later bucket, the pro of having my money in there is because it's deductible. Let's use this for an example. If I make $100,000 per year, and I allocate 10% of my pay to a 401k, for instance, the government sees it as if I only made $90,000 in that year, and the 10% that I put into my 401k is deductible. I can write it off of my taxes. That's the pro of having your money in a tax later bucket. The pro of having your money in a tax-free bucket is it's tax-free. Your money grows tax-free. Now, let's summarize what this actually means. Let's say you have $100,000 and all of your $100,000 is in your tax later bucket. Being that you're pulling out $100,000, your tax bracket is going to be a little bit higher than what it would be if you pulled it out, let's say $50,000. So let's stick with that $100,000 example. Let's say that your tax bracket that you're at is 25%. If you take 25% out of 100,000, you're netting 75,000. Now remember, when we started this video, I told you that the most important goal about retirement is not to accumulate the most amount of money, but to keep more money in your pocket and less in Uncle Sam's pocket. This is where that comes to play. Let's say we took that same $100,000 and we put $50,000 in a tax later bucket and $50,000 in a tax-free bucket. If we're pulling out $50,000 instead of $100,000, this is going to decrease our tax bracket. For the sake of numbers, let's say that our tax bracket is 15%. If you take 15% out of $50,000, that's $7,500 that you'll be losing out of taxes. So that puts you at $42,500. Now, if you're pulling $50,000 from a tax-free bucket, when you decide to pull that money out in retirement, it's already been taxed. So you're getting that money as straight net. So if you add the $50,000 to that $42,500, now your total net out of your $100,000 is $92,500 as compared to $75,000. This is why it's important to know that it's not about accumulating the most amount of money in one vehicle. It's about legally manipulating your tax bracket to have more money in your pocket in retirement and less in Uncle Sam's pocket in retirement. So what are the rules when it comes to your 3 tax buckets? Number 1, 0% of your retirement funds should be held in your tax now bucket. The reason being is that with your money being held in a tax now bucket, if you're planning on using that money for retirement, you're losing your purchasing power on your dollar. What is purchasing power? Every 20 to 24 years, the price of things doubles. And the reason of that cause is inflation. So if your money is sitting in a tax now bucket and not growing for you, you are losing the purchasing power on your dollar as it sits there collecting dust. You do not want any of your retirement funds in a tax now bucket. Number 2, well, Jordan, if I can just put all my money in a tax-free bucket, then I would just net everything that I'm going to put on retirement. Like, why don't I put everything in my tax-free bucket? This is why. If you're in a tax later bucket, whether it be a 401k, TRS, TSP, whatever it may be, you're most likely getting some type of company match from your employer. Why not take full advantage of the free money that your company is going to give you just for putting in what they're asking you to put in to receive that match? If your company's matching you 5%, why not put in 5% to take advantage of that free money that they're giving you? Now, if we're talking about anything over that match, let's say your company's matching you 5% and you're putting in 10% into your tax later bucket. Now that extra 5% gap, let's think about moving that money into a tax-free bucket. This is how you manipulate your tax bracket. The rule of thumb with your tax later bucket is that you want to accumulate somewhere between $300,000 to $500,000 in your tax later bucket. And the reason being is that if you pull too much money out of a tax later bucket, up to 85% of your Social Security can be taxable. Final rule, rule number 3. Know your rules of distribution. Now, we talked this whole video about accumulating more money in your pocket and less in Uncle Sam's pocket. And I can make a whole nother video on rules of distribution, but I just want to touch on 4 different risks that you may come across when it comes time to distribute that money to yourself out of what you accumulated. You may come across withdrawal rate risk, market risk, longevity risk, and inflation risk. Now, for some odd reason, a majority of the clients that we run to at New York Life always want to accumulate $1 million. I don't know what it is about $1 million, but $1 million is that number that everybody wants to hit.
$1 million.
Well, don't you think we should maybe ask for more than $1 million? $1 million isn't exactly a lot of money these days. Virtucon alone makes over $9 billion a year.
Really? Mm-hmm. It's a lot. Okay, then. We hold the world ransom for $100 billion.
Take this into consideration. Morningstar and Wall Street Journal says that 2.8% is the amount that you can distribute to yourself on an annual basis out of what you accumulated for retirement, so that it'll never run out on you in retirement. So if you accumulate $1 million in retirement, Morningstar and Wall Street Journal suggest only taking out $28,000 annually for that money to never run out on you in retirement. So when you think about accumulating $1 million, for some reason people think that you could take out $50,000 a year or $100,000 a year and you're just always going to be a millionaire. You have to consider longevity risk, you have to consider market risk, inflation risk, and withdrawal rate risk. And again, I'm not going to dive into those in this video. I can make another video on that and kind of go deep into that, but I wanted to touch on that because it's very important in terms of how you distribute and how you pay yourself in retirement.
Where's all your money gone, Donnie?
Taxes. 6, 9, 10, 11. Let me fix my houses.
Bug, it's okay. It's part of the game.
No, it's not.
It's
not fun.
It's not fun to what?
It's the worst part of the game.
Oh, it's what?
Taxes.
So that's all that I have for you today. My name is Jordan Hyde with New York Life. Thank you for tuning in. I hope you found value in this video. Remember that at New York Life, our #1 goal is to make sure that our clients have the tools to be successful on their journey to financial literacy. And again, it's cliche saying, but Rome was not built in a day. So however you decide to build your financial house, we are there to walk you step by step, and do not feel like you're alone. Again, 67% of people worldwide lack understanding of basic financial concepts. So that means 2 out of 3 of you watching this video probably feel like you are a little bit out of the realm when it comes to these conversations. No worries at all. This is our job and this is what we plan to do for you. Again, thank you for your time and stay tuned for more videos.